I probably have a phone call or two a month on, hey, I'm moving and we're going to get $600,000 out of our house or 200,000 from wherever. And we just want to put it all down on the house. And I'm like, okay, maybe you should think about, no, you don't really need to put down 20% if you don't have to.
So you get to write off all of the interest. And with that little bit higher interest that we're paying right now, that's significant.
Okay, I'm excited today because I have my friend Rebecca Pierce from New American Funding, and we're going to talk about down payments. No matter where you are in the stage of buying a house, if you're a first-time buyer, if you haven't purchased a house in 10, 20 years, 15 years, even 5 years, things change, and you have new parts of your life, your finances and everything that need to be considered in the process of how much money should we put down on this house. And if you're in your 50s, 60s, 70s, you lived in a house for a while, a lot of people call me and they want to put like all the money from the sale of their house they're living in now down into their new house. And well, that's not necessarily the best thing. So Rebecca is going to talk to us about the down payment and today's home market and some interesting things you might want to think about, consider, get your notepad out, because we're going to have a great interview here talking about the down payment. So people with more money, let's talk about that.
So people that have investments accounts, what I usually ask them is how much are they getting on the return on their investment? What's the interest rate? If they're getting 9, 10% on their interest rate, their money is better in that account than in their house.
Well, in a lot of things. I mean, from if they're very good at managing the stock market, or they own gold, or they have two other rental properties, or they're thinking about, wow, if we sell this house, buy the wee little house in Sonoma County, we could buy a rental property in another county that's better for landlords, and their money will grow,
Absolutely.
right? So putting in all your cash from the house that you might be selling into this house in Sonoma County might not be the best thing for you.
Absolutely. And that's what we talk about, each one. It's like, okay, what does it look like if you only put 100 grand down? What does it look like if you put 200 or 300? And then what do you do with that money difference if you don't put it down? Because 100 grand might be enough where you don't have mortgage insurance or that you have a small amount of mortgage insurance. We talked about this earlier. Let
Yeah,
me explain that about mortgage insurance. You only pay mortgage insurance if you don't put 20% down.
right.
So most people think, "Oh, I've got to go put 20% down." No, you don't. For example, someone that bought their house, they only put 5% down. Within 2 years, they had 25% equity. They were able to drop the mortgage insurance. So they didn't use up all their money or all their assets. Then their assets are more fluid because in this day, you don't know what's going to happen in any market. You're better to have your assets fluid than in a house because if you need money, you got to refinance to get money and then you have to qualify to get money. And some people lose their job, they can't qualify anymore.
Lots of things to think about.
Absolutely.
So today I'm talking to Rebecca Pierce from New American Funding, and I just turned on the camera because we were in the middle of a great conversation, and she's always got brilliant insight on some of our favorite topics. And as you know, we're talking about the down payment today and the current market and all the things that you have to talk about and think about when you're buying a new house and maybe selling and buying at the same time. So yeah, this is great insight because I probably have a phone call or two a month on, hey, I'm moving and we're going to get $600,000 out of our house or 200,000 from wherever. And we just want to put it all down on the house. And I'm like, okay, maybe you should talk to my lender. Maybe you should think about, no, you don't really need to put down 20% if you don't have to.
Right.
Yeah.
And that's where I will give them examples. I'm like, "Okay, let's look at this. What does it look like putting 100 grand and having that 100 grand in your pocket?"
Right.
And that way, if there is some reason that you're short funds to close, or I mean, just short funds during the month, then you've got some resources. Or all of a sudden, you have a hot water heater that goes out.
Yeah.
You've got resources.
And I talk to first time buyers all the time about how tough the first year is.
Mhm.
When you've owned a house, you've gone from having a landlord to, oh, we have to find a plumber.
Right.
Oh, there's a leak in the roof, which happened a whole lot this year. You don't know where to go and you have to pay for it.
Yes.
So a lot of times putting the least amount down possible kind of pads that bank account. Now, for those of you watching this and you're on your second or third house, you know what it's like to maintain a house. You're always kind of keeping your money over here because it's kind of a big debit. I mean, one or two times a year, maybe you go for 4 or 5 years and you don't spend any money on the house, but there's always something. Little things, $100 here and there at Home Depot, and all of a sudden you spent 4,000 in a year on everything from hoses to, yeah, your landscaping, but that little lock that doesn't work, or God forbid, the hot water heater or the furnace, which are
Right.
those big things. So, yeah, the down payment doesn't have to be 20%. But here's another thing I like to talk about with you, and that is the difference between paying a house, paying for a house with cash versus getting a loan, and why sometimes cash isn't always the best thing.
Right.
It's cool to pay cash and not have a mortgage. I think most of my favorite investors would be like, yeah. But at the
Yes.
same time,
Mhm.
you don't get any tax benefits.
That's right.
And so talk about that.
Right. Well, like you said, the biggest thing people they don't want a mortgage. They're like, "Oh, I don't want to stress over a mortgage."
Yeah.
But the tax benefits can be a lot. So you get to write off, depending on the tax year, of course, but typically you're writing off all of the interest. And with that little bit higher interest that we're paying right now, that's significant.
Yeah.
And then your mortgage insurance is normally a write off, as well as your property tax.
Yeah.
So those are all good benefits. If you're just writing your property tax off, that's not enough on a Schedule A typically for you to gain benefits for owning a home. The benefits is that you get to write off those expenses. So then you get to write off your medical expenses, then you get to write off your donations. So it starts this big write off on your federal taxes.
So let's touch on that. And don't get mad at me, viewer, but some people don't know what a write off is. And what
Okay.
we're going at, just I'll give you the third grade explanation because it's the easiest. But you make 100 grand a year and you have $30,000 worth of write offs, meaning the IRS says you can subtract all of that from your $100,000 salary and they'll only tax you on $70,000.
And that puts you in a lower tax bracket.
It puts you in a lower tax bracket, so
Right.
you don't pay as much income tax. This is
Right.
what Americans live for, is their write-offs. Every single thing you could possibly write off. Now, when you own rental properties and you're an investor, you're in write-off heaven because all tax law was made for basically the investor, not the employer or the self-employer a lot of times. So the more assets you own, and when you own a house, you get to write off what'd you say, your interest rate and your
And the
interest,
property taxes and the
property
mortgage
tax,
insurance.
which
Right.
come to about 25, 30 grand. Let's just make it that in Sonoma County a year. And then your little shoebox of all your receipts from the doctor and other things you think you can write off, then you can throw them in the game. Because you
Right.
can't even start writing off a dime until you reach, what's the number this year, 2023, do you know?
I
It's
do not.
it's
I
like 8 or 9 grand. I'm going to kind of make it up, but it's high. Like all your receipts in your shoebox have to add up to a certain amount of money every year before you can even use them as a write-off, right?
Right.
What's
It's
that
a
called?
standard.
Is that the tax? What do you call it?
The standard
The
deductions.
standard deduction. So every year, we could probably Google this. I probably should have done it before I recorded, but there's a standard starting point of
Right.
7, 8, 9 grand. And so all your receipts in your shoebox have to add up to that before you can start subtracting them from your salary. And when you own a home, you start with $30,000. So you can throw the shoebox of receipts in there, and now you might have 35,000 by the end of the time yeah. So you're only paying income tax on 65,000 instead of 70,000. So you want to live for your write-offs, and that's a bonus of having a mortgage, even a wee little mortgage, right?
Yes. One thing I tell everybody that is especially self employed is if you're self employed, please write off your mileage.
Mm.
You, a lot of people just lump it together under auto expenses.
Oh no.
On the mortgage side, we get to add mileage back in. We get to add depreciation back in. So when you're depreciating your home because you have a home office, that's a tax write-off that we get to add back in as income. So
Oh,
there's little tricks on the mortgage side that we can add back in as income. And that's two of them.
wow.
Right.
You add them in to look like you're making more money. Because
Yes.
that qualifies you for the loan.
Yes.
Ah, see?
Right. Right. So
There's
maybe you have $80,000 income, but you are writing off all these mileage, and then you're depreciating your house. So basically, say those added up to $10,000, then your income would be 90,000. We get to qualify you off
so there's these weird things you just have to know.
Yes, and that's why it's super important for people to call me up front.
Like a year
Because
ahead.
yeah, or when they first start thinking about it. And it's like, okay, and especially this time of year where it's today is April 15th, but
Yeah, I
before
know.
this,
It is April 15th. Wow.
right? And so, but our taxes have been extended till October 16th this year because of the floods in the state of California. So anyway, if they call me and they say, "Well, should I have you look at my taxes first?" I go, that's a good idea because some people don't know,
And
and
you
they think
happen to work for H&R Block for a long time.
for a little bit. So I
My
have a little
CPA.
knowledge.
Yeah, but she has a little bit of knowledge which she can put. Rebecca's great at just going, you might want to think about this.
Right.
Always consult your professionals. So Rebecca would be your professional lender, and your CPA can give you tax advice that we're supposed to disclose. Just letting you know. But Rebecca has insight
Right.
that
Yeah,
makes
let's
a
pull it all
difference.
together.
We've worked with a lot of people where they didn't know what they didn't know, and they got to get a house.
That's right.
Yeah.
Just recently, I had a client who was debating about putting 5% down or going FHA and putting 3.5% down.
Uh-huh.
And I, as a lender, know which one's going to be better, but sometimes they need to make that decision for themselves.
Yeah.
So I had showed them on paperwork, here's one and here's the other. And sure enough, they picked the same one I would have put them in.
Sometimes it's obvious, but you've never had the conversation.
Right.
Yeah.
Right.
It happens all the time, especially first time buyers, or maybe
Yes.
someone hasn't thought about this in 10 or 15 years. And they're like,
Right.
oh,
Well,
yeah,
yeah, most people don't buy but a handful of houses at the max during their lifetime, but yet we're in this daily and we
right.
do this all the time. So we know which one's the better options for people.
Yeah, it's a big, big deal. Especially now, people are a little whacked out. They're like, But I think the basic advice of not parting with your money if you don't have to is, or getting it locked into, a house. You can't get it out. Well, I suppose you can after a while, but
You have to refinance to get
if
it
you
out. Then
lost
you have
your
to
job,
qualify.
yeah.
Yeah.
So putting the least amount down, I think, is probably the wisest advice, and then go take your other chunk of your money and invest it elsewhere through your financial advisors and whoever may be assisting you with that. It's a wiser way to grow your money, right?
Right. Or
Yeah,
at least in the middle. You don't have to put no money down or little money. Just put that middle ground. And that's where we look at it and say, which one is best for you as an individual? Because
yeah.
everybody's different.
Yeah, everybody's different. And it changes all the time. So you're 38 years old and you're buying your second house
Mhm.
and you're like, oh, we got this. We bought our other house 10 years ago, 12 years ago, but it's 2023.
Right.
Talk to Rebecca 10 months to a year ahead and just kind of get the mask, stick it on the refrigerator,
Mhm.
because you're going to have to think about new things all the time. So, uh, basic stuff doesn't change, but a lot changes. A lot of the dynamics just change because that's how life is, right?
Yeah, I have my clients, excuse me, I have them I contact them each year and say, okay, are we in a good spot? How are things
Yeah.
going? Because they don't know what's going on in the industry.
Right. Yeah, you're good at that because sometimes people haven't thought of what you see all the time.
Right.
Like, what's a good example? So you call somebody and they
Well,
need some
I,
cash or
right. Well, a great example is over the last few years where the rates were really down
yeah,
and people just go about their life and they don't think about it. And I tell people, I was telling everybody, if you have not refinanced,
yeah,
go do it. You can do it through me or you can go somewhere else, but do it.
yeah.
And so people
Because that is
just
amazing.
absolutely. And it saved thousands and thousands of dollars. Otherwise, that money is just going flush down the toilet because for you, because somebody else is getting it. Why not get that better interest rate and then get that house paid off sooner?
Big reminder when your lender calls you 5 years after and you're all nestled in, just have a conversation. Because you
Right.
might learn something that you're like, oh, maybe let's talk about refinancing. It might lower your mortgage $300 or $500
Another
or
topic
more.
is your mortgage is your homeowner's insurance. People
Oh, yeah.
don't think to get a new quote. But even in my particular house, I had a California fair plan for the wildfires that we had. And the first year into it, I got to drop that because my insurance carrier covered it the
And
next
that's
year.
some bucks.
It is. So
Yeah,
that's why it's always great to talk to somebody that next year and say, is there anything need to be aware of?
I know.
I
I know.
talk
And now we've gone from drought to
floods.
Lake Tulare is now a lake again, or Tulare Lake it's called, down in the middle of California. It used to be bigger than Lake Tahoe, and now it's getting there again.
Yeah.
Yeah, it's going to be an interesting flood year for sure.
Yes.
Hopefully, all systems are in place, and the flood
Right.
control guys are hard at work because it's coming. Um, yeah, so it's always good to keep in touch with your lender because she knows stuff. Visit insurance and visit your lender, every year or two or three, or she'll call you,
Yeah.
right?
Yeah.
And because it's super important. So it really doesn't matter what stage of buying a house and selling a house you're in, whether it's your first house, your second or third, or you're in your 60s or 70s and you want to go from the big house to the wee little condo somewhere because you want to travel or just not travel anymore and not take care of a big house, wherever you are. The down payment versus cash and all these decisions is kind of ongoing and or may come up again in your life. And so there's nothing like talking to a great lender to make sure that you know all the new things and what's going on. And Rebecca's awesome at it.
Thank you, Anita.
Any other tips or things we want people to know or think about?
Wow, I think that covers it kind of
Yeah.
today.
I think we're
Yeah.
good. That was great. That was great. So give me a like and hit the subscribe button if you love this video. And the next video just for you is coming up right there.